All right, so this is the Monday morning mortgage update. Where are we today? It's the 17th of October. I can't believe this year's gone by so quickly. So here's today's agenda that we'll go over today. Rates, when will they stop going up? It's been a little rough, I'm not gonna lie. And then the Fed announcement, November, 75 basis points. It's pretty much set in stone. They're gonna do 75. Mortgage update, I'm gonna go over assumable loans. This is gonna be a lot of people don't know the details regarding assumable loans, so we're going to go over that. So you can see the pros and cons of that and how to set that up. And then a mortgage product of the week is what is the zero down wealth builder loan. So we're going to be going over that today. So first off, let's have a look at what's going on with inflation and with rates. So this month's core reading for inflation was 0.6. So that was much higher than expected. So we saw a tick upwards in the core inflation. The scary part about that is that excludes food and energy. Now, food and energy, gasoline, oil, all of that is actually a big part of the overall inflation numbers that we see on a daily basis as consumers. That excluded that. So it's more of the Fed's favorite index for inflation, because the core inflation is what they can control. They can't control food and energy. It's outside of their realm. So this was a big slap in the face, so to speak, because we thought that inflation numbers would come down a little bit or be a little bit more retained. And that was not the case. So what you saw in the bond market was a tremendous loss. So this was, in one day, we saw the stock market go down -400 and then reverse and go positive 600 in the same day. We also saw the bond market drop 180 basis points. It fell all the way down here and then did a total reversal and came all the way back. It was one of those days that Captain Morgan and Johnny Walker might have been the best friends of people for the day, because it was just unbelievably volatile. The very next day, we lost another 100 basis points, and then we came back down back today. So the volatility that's happening is just astronomical. 180 basis point move like that typically takes a few months on a like bad market. It happened in one day. So last week was just rough. I'm not gonna lie. And it was all because of the core inflation rate coming out hotter than expected. But also in the UK, they're going through a lot of monetary policy issues right now. They started doing some tax breaks. It went over poorly, so they're now trying to revert that back. The pound is losing value like it's going out of style. I mean, it's unbelievable how bad it's being hit versus the dollar. So there's a lot of monetary issues going along globally that are kind of exacerbating the volatility. Here's a really interesting volatility matrix or index of how volatile the markets have been in the timelines. So if you go back to 2020, when COVID hit, there was massive volatility for a very short period of time. A while back, we saw pretty big, it was 4 months of volatility, pretty wide stretch. Back in 2017, there was a couple months volatility. We're at a 9-month, really highly volatile peak right now. So it's a very long, drawn out volatility index, and it's just difficult to really, as a mortgage professional, if somebody says, what's your rate today, literally it's good for an hour. It's it's unbelievable. So it's frustrating borrowers, it's frustrating lenders, it's just highly volatile. It's just tough, just really, really tough. So kind of let's look at where rates are right now. We are above 7. So we're at 7.16 on average for 30-year fixed, 15's 6.4, jumbos in the 6s and the lower 6s. This really ranges because there's a lot of different jumbo lenders depending on their guidelines, but the creme de la creme, the higher, the better ones are right around the low 6. Adjustable rate mortgages, look at that. They're actually higher than a 30-year jumbo. And then we've got the FHA in the mid 6s and VA in the mid 6s. So rates continue to be high. It's tough to say where they will go based on the next month. However, if you look at all of the major forecasters, I guess is the best word for it, as far as what the future will hold. There should be the indexes getting lower yields by middle of next year, and they expect the 10-year to be closer to 3. That would yield mortgage rates in the 5s again. So we will see a dip in mortgage rates. So that, you know, that old adage of marry the home, date the rate is still important to follow. So with that being said, there is a lot of loans out there right now that are really low. So let's talk about assumable loans. So right now, assumable loans are only those loans that are guaranteed by the federal government. So what are they? It's an assumable loan is a mortgage where a buyer can take over the seller's mortgage balance and the terms as part of the process of buying that home. So are there assumable loans out there? Yes. And I had to really kind of re-educate myself because it's been a while. It's been a minute since we've had assumable loans actually be attractive. But this could be a very good way to market your home. It could be a very good way for your buyers to get into a much lower rate. But we have to really tear apart now what is an assumable loan, what loans are assumable, and get to the nitty-gritty of this. So let's first look at the details. So first off, all FHA after 1989, all FHA, VA, and USDA loans are assumable loans. So let me go over the details. That's only federally guaranteed and insured mortgages. That's what those are, FHA, VA, and USDA. Conventional loans are not federally insured or guaranteed. So borrowers also, they must credit qualify for this loan that is being assumed. So they have to go through the whole underwriting process by the seller's servicer or by the mortgage company that holds the seller's mortgage. So it's a little unknown as to how good they are or how fast they are. So that's another thing we have to look at. But let's just say that the seller's mortgage is $250,000 and they're buying it for $500,000. Well, if you assume a $250,000 loan and the home's $500,000, you have to bring in the difference. Or you can get a piggyback loan or a second mortgage to bring it to marry or to bridge that gap. So there are some parts of it that we need to navigate. You can only do an assumable loan if you're buying an owner-occupied property. So it has to be your primary residence. VA loans are unique because the veterans, if a veteran is assuming a loan, that veteran could adopt that completely and have the seller reestablish their eligibility as a veteran. But if a non-veteran, somebody that's not a veteran, they can still assume a VA loan. However, that VA veteran on the seller side doesn't get their eligibility restored. So they are not able to get another VA loan on the maximum 100% financing if they let their loan be assumed by a non-veteran. So there's some really quirky things with VA loans, but anyone can assume a VA loan. It's very important to check if the seller gets a release of liability at closing too from the loan that's being assumed. So all FHA, VA, and USDA loans are assumable. So let's look at some of the pros and cons. First off, the pros. Massive benefit is the rate. If you can get into a rate in the 2s or 3s, that is a huge win for a buyer in today's market. And as a seller, it's a massive benefit to get people attracted to your home. If you've got a veteran that just bought their home 2 years ago, their rate is 2.875, and they've got a pretty big loan on their home compared to the actual sales price, that may be a great way to advertise that home. Like, loan is assumable at a rate of 2.875, call me for details or see if you're eligible, would be a great thing to advertise. So I think there's a lot of pros. There's a couple pros, but they're big. They're big, phenomenal ways of getting a really low rate. Now, let's look at some of the cons. The buyer still must qualify for that loan type that's being assumed. So veterans or non-veterans can get a VA loan, but if it's an FHA loan, they have to go through the FHA qualifying. If it's a USDA, there's income caps that they have to qualify for that loan type. However, it's through the seller's mortgage company. You can't choose your own lender. So that's very important. You have to go with the seller's lender who's servicing that loan and get approved through them. And then the buyers are needing to bridge that gap between whatever that loan amount is that's being assumed to what the purchase price is. They have to bring in that difference. Now, you could get a second mortgage like I talked about. Now, the timeline of that lender getting that loan approved may be 60 days, 90 days, it could be 15 days. So that needs to be pre-vetted to figure out what that timeline would look like. Because market trends may make it very difficult for a seller to want to accept an assumable loan in light of another offer. So if another offer can close in 15 days, but the assumable loan is going to be 45 days, even though it might be great for that buyer, it's not good for the seller because they might have to wait longer. Now, also the cost of assumable loans may be high. So talk with the seller or the servicer on their loan to see what the costs are associated with assuming that loan. There could be points involved or upfront fees, not upfront, but very expensive fees to do so. Or there may be none at all, just a normal standard transaction. Everyone varies when it comes to the servicing of that. And then be careful because the sellers may be held liable on the loan that is assumed, depending on the date of the original mortgage, or if it's a veteran to a non-veteran, you don't want to lose that veteran's eligibility by assuming it to a non-veteran unless they don't need another VA loan in the future. So some really interesting things about VA loans that I want you guys to make sure you understand when it comes to assumability. Questions to ask. These are very important questions to ask. First off, is the seller's mortgage assumable? We have to make sure it's assumable because you can't just assume that it's assumable because no conventional loans are. There are some private money loans that may be assumable. So ask the seller to look into it, have them call their servicer to dig into it, or they can look at their paperwork on their closing. 9 times out of 10, it's hard to find. So just calling the sellers or the servicer on that loan is probably the easier way. Ask what the costs are, what amount of the loan can be assumed. Oops. That's a very important piece. How much of that loan can be assumed? Because there may be a circumstance where they say it can be assumed, but a much lower loan amount because we don't like, or they don't qualify for as much. So they consume maybe 150 of the 200, or they just got 100% financing. We're only going to let you assume 80% of it. There may be a reduction in principal on what can be assumed. So we need to ask those questions as well. And then how much does the seller need to bring in at closing? That's a big piece. Second mortgage needed. What is the timeline for closing? And will the seller get a release of liability? Those are very important questions to ask when looking at assumable loans. So we're going to look at the wealth builder, but I'm going to stop sharing and ask if you guys have any questions on assumable loans at this point. Here's one. If you're getting a second to cover the gap, can that be through a separate lender from the one who is allowing assumption by the new buyer? Yes, it can be. So any lender that offers home equity lines or second mortgages can do it. However, it's somewhat of a back and forth with the communication with the first lender and the second lender to make sure everyone's on the same page. It can get a little dicey. Regarding the release of liability, is this provided in writing from the current mortgage company? Yes, it is. So you can ask them if there is any type of release of liability that will happen. For the most point, all of them will get a release of liability. If it's a loan that was funded by FHA prior to 1989, there are some weird circumstances surrounding the paperwork in those that you need to review. What is the best way to tell if a loan is FHA if the seller doesn't know? Right on the borrower's credit report or on their mortgage statement, it will tell you the loan type. So I didn't answer part 2 of that question. Is it recorded by the escrow company? That's a good question. Angie may be able to find that out for us, but the release of liability is basically a credit liability. I'm not sure if it's something that's recorded or not. So that's a really good question. I'll have to look into that. But yeah, the best way to tell if it's an assumable loan, any FHA, VA, or USDA, it'll show on the actual mortgage statement what kind of a loan that is. And if it's any one of those 3, if that was taken in the last 30 years, then you are good to go as far as it being assumable. Now, will they qualify for that is another question altogether. You can't just assume it without qualifying. Borrower still needs to qualify and go through that process. But you can absolutely put in your listings, we have an assumable loan, call if you're to see if you're eligible. It's a great way to get some activity on your listings, especially if it's a VA, FHA, or a USDA loan that is on that house. Any other questions regarding assumable loans? I can't believe I'm actually talking about assumable loans. I thought they would never, ever be part of this market ever again. But hey, here we are, right? It's unbelievable. But all right, well, I'm going to get right into the next phase, which is our mortgage highlight of our product of the week, so to speak. So this is called the Wealth Builder. So I'm going to start this again right here. I'm going to share my screen. Bear with me when I figure out how to do this. Share screen. All right, so let's start all the way from the beginning. Let's do that again here. Sorry for this, guys. I stopped and started it too fast. Okay, so the Wealth Builder. This is a program that we have. It's exclusive to our company. Keep in mind, we are a mortgage banker, a mortgage broker, and we have access to bank's products. Waterstone Bank has their own products, and we have 100% access to those in-house. So this Wealth Builder program is a 100% financing program. And I'm going to show you the difference between this and a first-time home buyer 3% down home ready program to show you the difference. Now, the main difference between this product and a traditional 3% down is this is actually a 20-year term. So it's amortized on 20 years, but it is an adjustable rate mortgage. So let me make sure you understand that. This particular loan is a 7-year fixed rate, adjustable rate mortgage. So the rate is fixed for the first initial 7 years, and then it can adjust every year after that, but it's amortized over 20 years. So it's unique. It's very unique. So follow me on this. I put together a scenario of the Wealth Builder and the 3% down home ready to show you the difference and what this looks like for the consumer. The reason it's called a Wealth Builder is they are paying a significantly higher amount of principal into their pocket every month, and the rate is a little bit lower. So it's a 20-year term, the rate's a little bit lower, so their equity position is going to be growing dramatically faster. And I'm going to show you what that looks like, but I'm going to go over a little bit of the basics first. So first off, interest rate. 6.5 on the interest rate is today's rate on the Wealth Builder versus 7.25 on the 3% down home ready. Look at the amount of money out of pocket needed. $11,000, that's paying all your closing costs and everything. And that's a pretty high estimate versus the 3% down home ready, which is $25,000 closing costs plus down payment. So they'd be able to maybe pay off a bunch of debt this way to qualify. They'd be able to do quite a bit because they're going to have another $13,000 extra in their pocket by going this route. Now, another thing I want to show you guys is the actual payment. It's only $100, $180 more to do a 0 down. So it's $180 better on the 3% down. However, there's no mortgage insurance on the Wealth Builder loan. It's built into the loan. And the amount of savings over a 60-month period is $32,573 over a 5-year period. Now, over a 10-year period, it's almost $100,000 in savings in interest, and what you're paying yourself in principal, the overall savings is dramatic because there's no monthly mortgage insurance. You're paying yourself instead of the bank. And then what I want to show you next is the amortization schedule. So here's the Wealth Builder, and I'm going to go back and forth on this. So principal and interest, if you've never seen an amortization schedule, the bank always makes the most money up front. So interest is always the most, and then it slowly goes down over time, how much interest you pay. Now the interest is always based on the note rate, but an amortization schedule pays the bank first. That's the magic of the amortization schedule. And then the principal is what you're paying yourself towards paying the loan balance down. Now I want you guys to fixate your eyes on this number right here on the principal on month one, the principal payment on this loan compared to a 30-year 3% down. I'm going to go to that next. Watch this. $1,047 versus $388. Look at the dramatic difference in how much you're paying yourself in principal. I mean, it is massive difference. $1,047 versus $388. Now you know why it's called the Wealth Builder. And hold on as I get rid of this call. That's over $600 a month that you're paying yourself. Now let's look back at the payment again. It's $180 more a month to do the Wealth Builder compared to the 3%. So you're going to save $180 a month doing this, but you're paying yourself over $500 more a month in your pocket. That's why the savings is so dramatic by doing this program. So engineers, accountants, all of these numbers people look at this program and they go, wow, this is a no-brainer. It's a really, really good product, a very unique product, and it's a tremendous tool to help your buyers really get ahead. So that is the Wealth Builder program. I'm going to go ahead and stop sharing and answer any questions that you have. Does that payment of $41.28 include PMI? So on the Wealth Builder program, if you look at the Wealth Builder, it's on the 3% down home ready. Yes, it does include mortgage insurance, but there's no monthly mortgage insurance on the Wealth Builder loan. It's actually rolled into the loan. So it's zero down, no monthly mortgage insurance. So you're paying yourself a lot of money towards principal, and you're not wasting your money on the actual mortgage insurance. Because it's a 20-year AM, you're paying the loan off much quicker.
What kind of buyer would qualify for that loan?
Any buyer. Anyone. You have to qualify, obviously, on a 20-year AM, but it's not specific to a first-time home buyer or anyone else. It is really open to whomever fits the guidelines. It's a really unique program, and let me pull up something real fast. Hold on one second. I am going to have it right here. I have a little cheat sheet for me on this Wealth Builder. So it's available up to a pretty high loan amount. It's a new product to me too, so I'm really excited about it.
I mean, it looks too good to be true.
It is. I mean, it really is. And I'm talking to some of the loan officers that are here at the mortgage company that have had it for a while. It is a really, really phenomenal tool. So I will send you the breakdown of the eligibility to everyone on this call, so you guys can see that as far as who can fit into this box for this Wealth Builder loan. It is extremely unique. It takes some really detail-oriented explanation for the buyers to understand it, but through the programs I have through the Mortgage Coach program, which gives a side-by-side analysis, it makes it easy for them to understand. But any conventional loan, I think it goes up to, I'm pretty sure it goes up to close to $1 million. But I'll get that information for you. I don't want to, but of course, any conventional loan limit, it'll go up to. So 9 or 715 or 710, depending on how the conventional loan limit comes out. Anything available in that realm will work. So it's a great program. Sounds like the downside is the adjustable rate after 7 years. If you're a good rate to start with, I guess. Yeah, so you're going to get a little bit lower rate than what's currently available right now in the markets, but it's fixed for 7 years. And guys, 7 years is a very long time to have the ability to refinance in that timeline. So if for any reason they wanted to refinance into a traditional conventional loan at a 15-year when rates dropped, by all means do it. There's no prepayment penalties on these. You can refinance after 6 months if you wanted. So let's just say a 15-year fixed in 2 years is 3.5. Okay, refinance into a 15-year. I mean, you're just going to better the position, and then you're locked in for 15 years, and you're never going to have to see that rate adjust. So The average loan on record right now is lasting about 2.5 to 3 years. So people do refinance and pay off mortgages quite frequently. And remember, only about 50% of the country even has a mortgage. About 50% of the homes in the United States are free and clear. So interesting thought. But this is a really, really great program. Yes, it's a 20-year term. So any questions on this? And every week, I'm going to do another outline of another unique loan that we have. We've got a lot of arrows in our quiver, so to speak, as far as what we can offer our customers now. One of the reasons I made the move. It's exciting. It's really exciting. So I'm going to go ahead. This is being recorded, so I'm going to send this recording to you. I'm also going to send you a list of the guidelines so you guys can see exactly who this would qualify, who can qualify for this program, and kind of where they need to fit in the spectrum there. But yeah, it's a really, really great program. I don't think it's available on manufactured homes. That is one of the items. Let me double check on that, and I'll address that in the email. But great program. Again, I'm learning a little bit on it as well. I'm just super excited for it because how the payments work out, it's just a tremendous value. All right, any questions on the markets? It's going to be a volatile day, guys. If you guys follow what's called the VIX, the volatility index, it's really, really wild. No, it's not. Sorry, Jason. It is only available for owner-occupied properties. So good question. But it's going to be very volatile throughout the remainder of this year until the markets kind of get a grasp on inflation and monetary policies across the different countries and everything else that's happening right now. Can you show the amortization balance left after 7 years? I can actually. Hold on 1 second. Let me share my screen again. Bear with me 1 moment. I am going to jump back in here, share screen. I'm going to go back into Mortgage Coach. Bear with me, guys. I'm going to show you a long-term analysis of this so you can see. Preview highlights. Let's go into presentation, amortization schedule, preview amortization schedule. All right, so here's the amortization schedule on the balance and the total principal and the total payment. Let's go into like 10 years. On this one, let's see, it doesn't keep the column ahead. So let's see what 283 is. What is this column right here? So the total interest over 10 years is 176,000. If you compare and contrast, I mean, these amortization schedules are kind of hard to read. They kind of show everything over a while, the interest you pay, total payment, total principal, kind of checked up here. So let me go over to compared to the home ready over a 10-year period. Let's go down to 120 months there on the interest. And you're at 339,000 in interest. So pretty dramatic difference. 339 versus on 120, 200, is it 282, 281,000? The second column is interest. Yeah. So pretty big difference. The principal is what the major number is. So if you look at the column right here on principal, this is the wealth builder. Let's look at 120 months again on principal. Let's see where we at. Total principal. We need total principal right here. Total principal. 120 months. $176,000 in principal versus the 3% down home ready under total principal under 120 months. Only 68,000. Huge difference. So the amortization schedule is what doesn't lie, right? That's where a lot of engineers like to create their own on Excel spreadsheets and kind of figure out what they want to do moving forward. Oh, did you guys see that? I don't know if you guys actually were able to see that. Did it share on my screen or did it not? It did? Okay. All right, that scared me for a second there. 7 years, not 10. Never mind, I get the gist. Okay, sorry, Karen. I can adjust it to be whatever you want on those programs as well to kind of show you what the overall savings is. But it's significant. It's definitely significant. Any other questions regarding that program? All right, well, it's going to be another volatile week. I promise you that. If you guys have any questions on any of the programs that are out there, hit me up. I'm always here. And do have a wonderful week. And I will stay on the call for a little bit longer if you guys do have further questions. You're very welcome, John. And again, I'll send you guys a snapshot of the actual guidelines, the nitty-gritty, so you can kind of see exactly how it works, or as far as what buyers are available for this product. You're very welcome, Mike. You're very welcome, Emma. Thank you. You guys have a wonderful, wonderful week. I do, Greg. It's going to be recorded and sent out to everybody. So expect to have it in your inbox by end of business day today. All right, guys, we'll have a phenomenal week. And again, I'll always be here. And it's volatile, it's crazy, but this too shall pass and the markets will be back to normal, hopefully sooner rather than later.
Oop, left you quick there. Can you hear me, Sean?
Yes, I can.
Cool. So yeah, quick question about the first-time home buyers. What are the benefits of that towards, the other mortgage loans? Or what benefits do you know, what is the, benefit for a first-time home buyer to get that type of first-time home buyer loan, I guess, if I'm asking that correctly?
The benefit of that wealth builder program?
Well, not that one specifically. I'm just asking,
Just
I have an overall, yeah.
Got it. So just kind of to circle back a little bit on that, there's probably 12 or 13 different first-time homebuyer programs. Each have their own benefits. There's a Home in 5 program. There's Chenoa down payment assistance program. There's the 3% down, which is the Home Ready program. Each of them have different benefits. So the grant programs help with down payment. So if you don't have any money for down payment, they can help you, but the rate's higher. So they all have pros and cons. The 3% down Home Ready is discounted mortgage insurance. So the mortgage insurance is cheaper. And if you have lower credit scores, that program doesn't hit you on the rate as much as a normal conventional loan would for having a lower credit score. So their loan level adjustments are limited. So as an example, if you took a Home Ready rate with a 680 credit score and compared that to the same borrower on a traditional conventional loan, with a 680, the interest rate would be about half worse on a traditional conventional loan compared to the Home Ready. So there's some benefit on them getting that program to help with the rate. So really, it's a hard question to answer. Every first-time home buyer has a unique requirement or need that some of these may be able to help with, if that makes sense. But you can either do zero down, or there's adjustments to help them get a better rate if they have lower credit. There's a large realm of different possibilities there.
I gotcha. All right. So, and then it really just matters on their credit as well, right?
Yeah, credit's a big factor. A lot of times FHA is a better route for those really lower credit scores because FHA has less adjustments to the rate for lower credit. And plus it allows people that may have had a little bit of poor history of credit to get into a mortgage sooner rather than a conventional, as far as the waiting periods after a bankruptcy, foreclosure, something like that. So there truly are a number of different reasons why one first-time home buyer would want one program compared to another. And it really just depends on their own individual circumstances. But it's kind of a convoluted answer.
Not a problem. I appreciate it. Thank you.
Yeah, not a problem at all.
All right, perfect. You have a great day.
You too, sir. Have a good one. All right, well, it's Monday and it's time to get after it. And Lisa, Vicky, Sophie, Vic, if you guys have any questions, I'll be here for just a few moments longer. If not, then we will talk to you guys later, and you guys have a phenomenal week.
Thank you so much, Sean.
You're very welcome, Vicky.
Awesome.
All right, have a great one, guys.